Good afternoon. My favorite part with the gavel. Good afternoon. I hope everyone had a wonderful lunch. I am a New York Assemblywoman Pam Hunter and NCOIL President, and I'll be chairing this meeting today. I'll first entertain a motion to waive the quorum requirement. Can I have a motion? Second? All in favor? Fabulous. And now I'll entertain a motion to approve the November 23rd, 2024 committee meeting minutes. May I have a motion? Tom, a second? Thank you. All in favor? Perfect. Before we get started, I'd just like to say I really appreciate you all being here today. On behalf of the NAIC, we have a strong, big group today, and I look forward to our organizations continuing to strengthen our relationship. Definitely when our organizations are in positions of strength and able to cooperate with each other, that ultimately benefits consumers and our state-based system of insurance regulation. So thank you. I appreciate your large group being here today. And fitting with that theme, I think all of you have, I'd like to mention printed out before you is an op-ed that was authored by myself and NAIC President John Gottfried, celebrating the state-based system of insurance in light of this year being the 80th anniversary of the McCarran-Ferguson Act, and that was the topic of the Griffith Institute luncheon today. You can also view it on the app and the website. And I do think that this op-ed is a great example of how the relationship between our organizations has improved over the year and strong foundation for us to keep moving forward. Before we get started, can you all please introduce yourselves before we get started with the agenda? And we'll start with the president.
Sure. Thank you, Madam President. John Gottfried, North Dakota Insurance Commissioner, as well as NAIC President for this year.
We'll share John Pike, Utah Commissioner and Secretary Treasurer of the NAIC this year.
Glenn Mulready, Oklahoma Insurance Commissioner, and I chair the Health Insurance Committee at the NAIC.
Michael Wise, South Carolina Department of the Insurance Director.
Patty Puder, Office of the Insurance Commissioner, Washington State.
I'm Nathan Hodak, Wisconsin Insurance Commissioner, and I serve as chair of the Financial Commission Committee.
Mike Jaworski, Insurance Commissioner for Florida. And John King, Insurance Commissioner for the great state of Georgia.
Beautiful. Thank you all. Welcome for being here. We're going to do a recap of the NAIC spring meeting and discuss the NAIC's 2025 priorities. Last month, you all concluded your spring meeting in Indianapolis. And as usual, there are many items discussed and actions taken that have a major impact on the insurance marketplace. And also earlier this year, you all set forth your several priorities at both state and federal level. So can you touch on some of the highlights from your spring meeting and also discuss the NAIC's priorities for this year, please?
Yeah, absolutely. Thank you, Madam President. And before I get started, I just want to say thank you to hosting us, having us here. I think your comments about when we work together, everything's a lot better, and I certainly agree with that. And I've been Insurance Commissioner for 8 years. This is my first NCOIL meeting, and I'm going to give a little bit of a background on why that is. Prior to my being elected the North Dakota Insurance Commissioner, George Kaiser, who was a strong force in this organization for a number of years, met with me, and he said, "We're not joining the compact, and you don't need to worry about going to NCOIL because I got that covered." And at that point, I was a Chamber of Commerce guy, and I'm like, I don't even really know what either of those two are. And I said, "But you're the chair of the House Insurance Committee, and I'll respect your wishes." Now I think he's keeping a secret from me, and so I'm very happy to be here, very happy to be a part of it. And again, an opportunity for us to meet with policymakers and talk through these issues is so critically important. And the closer organizations can be, the better that is for the states, and the better it is for state-based regulation. And I think that the op-ed that we were able to author together really outlines that. I've been pushing hard for my organization to make the 80th anniversary of McCarran-Ferguson a gift-giving opportunity for the presidents of the respective associations. I haven't been successful in that, so I hope, Madam President, you may be a little more successful than I am in that gift-giving holiday opportunity. But jumping into the Indianapolis Spring National Meeting we had back in March, we had a very good turnout. It wasn't quite a record-setting turnout like yours is here, but we had a good participation from across the industry as well as regulators. And we've really hit the ground running this year. We've reorganized how we're doing some of our priorities and how we're kind of outlining some of our governance within the NAIC, really taking a hard look at governance, really taking a look at the hard work of the different parent committees that we have across the association and trying to give them some more directives and some more key working opportunities. Again, getting back into what is the value of bringing stakeholders together is doing the work in front of them and having that robust discussion as much as we possibly can. And so continue down that road. Some of the highlights from the meeting are really the kicking off and deployment of our RBC Model Governance Task Force. That's being led by Commissioner Hodak, who is also here at the table, as well as Director French from Ohio. They've been tasked with doing a pretty comprehensive analysis of our RBC framework and looking at a gap analysis, looking at some principles behind RBC, the RBC framework. This is one of the key tools we use for financial regulation. I would stand it up against any financial regulatory tool across the world. And so part of this process is to conduct a gap analysis, make sure we're doing, when we want to make changes to the RBC or changes to our analysis, that we've got some principles behind doing that. I think it's really important. The investment landscape is continuing to evolve and continue to change. And the insurance industry needs to be responsive to that. Their industry is responsive to it. The regulation also need to be responsive to that and make sure that we're allowing reasonable and responsible capital into the market. Again, I think there's a great opportunity here when we talk about closing coverage gaps or serving underserved communities. It's really hard to, if not impossible, to do that without additional capital. And that's on all lines of insurance. And so our capital regulation must be flexible. It must be certainly responsible. But as our markets change, we've got to be able to take a look at how do we evolve as well as an industry and allowing those capital formations into our industry where they fit and what's appropriate. So Commissioner Hodak and Director French are certainly leading that effort. Director Wise is also a co-vice chair. We've got kind of I like to say we've got the who's who of financial regulation kind of leading this leading that work. And so we're really excited about the work they're doing, and they've really been pushing very, very hard. Another key point is through our C committee, our Property and Casualty Committee, and there's been a lot of work done by Commissioner Jaworski, who's also at the table, on the data collection piece. You may remember there was a lot of talk last year about the PCMI data call and some of the interactions with FIO, and what does that mean for our market. And given, I think we can all agree there's probably a lessening of some pressure coming from FIO on that piece, it gives us an opportunity to collectively come together as regulators and figure out how do we want to do this going forward. The data is necessary. We need to have the data on our markets. We need to have understanding of what's going on in our marketplaces so we can provide that to you all as policymakers when we get questions. I often get questions from my legislators on how many homeowners have a daycare liability rider, or how many homeowners have this, or how many, and for a state like North Dakota, where we're really rural, that would mean doing a data call to get that information. I don't have access to that information, or if I do, it's likely 2 years old. And so as we all look at making policy decisions, they're driven by data, and we've got to have that fundamental underlying data to make those policy decisions. And so Commissioner Conway out of Colorado is the chair of the C committee. Commissioner Jaworski is one of the co-vice chairs, and him and Commissioner King, I think, have been also tasked with trying to come up what does this data call model look like going forward, so we can be a little bit more uniform and standardized, so that when we do a data call as an industry, we're not trying to reinvent the wheel at every state, and so that becomes a costly process. One of the other pieces in the agenda is looking at the affordability and availability of insurance. We may touch on that a little later, but that's another priority of the C committee. Touching on big data and AI briefly, we presented a 4-step roadmap to responsible AI use. So we've also looking at the G committee, which is our international committee, looking at the implementation of the insurance capital standard, and the aggregation method and how that's going to work internationally. That'll be led by Director Dunning, who is our G committee chair. I do want to jump into our federal priorities, if that's all right with you, Madam President. Again, I'll leave probably the biggest one for last here, touching on the federal claims filing deadline. Again, extending a 2-year deadline for the federal government to file claims against insurance receiverships. Really looking at supporting natural catastrophe mitigation. There's been a lot of discussion around FEMA, around the NFIP, around what dollars are going into disaster recovery, and I was fortunate enough to sit on a wildfire roundtable back in January with the House Financial Services Committee, and was a little surprised at the discussion, on how the discussion went. It really shifted to mitigation and how do we use federal dollars to enhance community mitigation, and where can that go? And so continue to there's a suite of federal bills out there right now, congressional bills. I don't think we haven't picked a lot of favorites yet, but it's the mentality of driving mitigation down into the communities through the states is certainly a really, really good first step into preventing loss in the long term. This isn't something you do and you flip it and it turns overnight. We're not going to be able to change building codes or implement, significant mitigation across our communities overnight. It's a step that we've got to continue to take so we can make our communities resilient for the long term. Also continue to oppose any preemption on the privacy, cybersecurity, AI front from the federal government. That's a little bit more of a sweet spot that we've got to look at. We have done a lot of work on privacy at the NAIC. We've done a lot of work on AI. If there's one area I think that Congress will eventually come to some agreement on, it is on privacy. Everybody hates big tech for various different reasons, depending on what side of the aisle you're on. And so the threat of Congress coming together and coalescing around some privacy model, I think is very real, and it's why we continue to work on our privacy model law at the NAIC. Lastly, also on the federal side, the extension of the premium tax credits, I think, is another key issue that I don't think I know a commissioner who is opposed to extending those tax credits, giving the access that they provide to our consumers in our states to receive health care and have access to health insurance. Always looking for more market flexibility on the health side, anywhere we can get it, and then also working with CMS, SIO, and HHS to really look at the Med Advantage oversight. We've been asking to pull that back into the states to allow us to enforce some of the bad actors that are operating in the Med Advantage space. I think there's some understanding around that. There's some agreement to that. It's just a matter of getting over that hurdle. The last federal priority is we did meet together as a group of commissioners, and we came to consensus around calling for the elimination of the Federal Insurance Office. It's a new step for us, I think, as the NAIC. We've often talked about the discussion around FIO and what role it plays in the industry, but we were able to get to a point where bipartisan agreement on calling for that elimination of FIO, given, and this is John speaking, I'll let my other colleagues speak for themselves as well, but it hasn't been a very successful partnership in our eyes on how we operate together, and I think the PCMI data call is a prime example of that, and I don't need to get into rehashing all that, but there wasn't a whole lot of feeling of true partnership around how we're sharing information, how we're sharing data, and how we're analyzing it. And so I think, given the direction where we are, there could be an opportunity for us to support, Commissioner Downing, or Congressman Downing's now, bill to call for the elimination of FIO. That's a real quick overview. There's one other issue I'd like to bring up, Madam President, if you're willing, on one of the model laws that you all have before you here at this meeting. I think as state insurance regulators, one of our core responsibilities is to continue to ensure that our consumers are protected, and we all share in that goal, right? And that markets remain stable and our companies operate within a fair and transparent regulatory framework. The revised Rental Home Marketplace Guarantees Act, I think we can understand the intention behind it. We can understand the desire behind trying to address some of the innovation in that sharing economy, but it does continue to raise some fundamental concerns for us. And if you'd be okay with it, I'd like to turn over to Commissioner Kuderer to walk us through some of those, if you're okay, or we can certainly turn to a different topic if you'd like.
Thank you. And I just want to start by saying it's an honor to be here. I've been here before as a legislator, and now I'm here as a first-time commissioner of insurance. And I also want to say that South Carolina's slogan is made for vacation, but its motto is be prepared in mind and resources. And that all feels very appropriate for this discussion because both are foundational to my remarks today. We can all enjoy a vacation rental, but we can also be prudent in how to legislate it. And that's how my office regulated Airbnb when we took legal action against it a few years ago. I'm still a little new to my role as a regulator, but I'm consistently impressed by the work of our legal affairs team and the standard that they've set for proactively regulating corporations that engage in the insurance business but don't consider themselves within our authority. We started looking into Airbnb's host damage protection program in 2022 as a result of a consumer complaint alleging that the $1 million in coverage for host property damage was merely a marketing scheme. Airbnb had been offering this coverage since 2012. That coverage was meant to cover up to $1 million in guest damages to the host property. The same bucket of coverage offered host and experience liability coverages, all under a general commercial liability policy issued to Airbnb and then extended to the host. In addition to misrepresenting the coverage offered to consumers, Airbnb wasn't licensed in Washington, so this was an issue with us as a regulator. In the end, Airbnb admitted it violated our insurance code and agreed to a $20,000 fine and to secure a surplus lines policy through a broker licensed in Washington. And we also made the company review 1,168 denied claims from January of 2021 to August of 23 and pay out all improperly denied claims to date. Moving forward, the company agreed that all future claims paid out would be determined by an insurance adjuster licensed in Washington. The proposed model law before you now, as written, takes a large step backwards from the work we did in Washington and will codify into law the idea that rental home marketplace entities can operate outside the insurance code without regard to the negative impact on consumers. From my perspective, the revised model law is a direct response to Washington holding them accountable for violating our insurance laws. It is too broad, it cuts important consumer protection language, and it restricts our ability to create rules that govern these entities, despite them operating in our field of regulation. Section 4 alone establishes that these businesses would be outside the insurance code in Washington, and the revisions in Section 6 gut what little consumer protection language this bill had, including disclosures on whether the guarantee is covered under a reimbursement insurance policy, whether disclosures identifying who provides payment under the contract, disclosures on the purchase price and terms of policies sold separately, disclosures on any damage recovery minimums, disclosures on cancellation and refund policies, and notification requirements prior to contract terminations. The proposed legislation establishes something resembling travel insurance, a product that already exists and that we already regulate, and rebrands it as a rental home marketplace guarantee. And it's labeled a guarantee despite repeatedly using the term insurance to describe the product that would pay the damages covered by the guarantee. This proposed model legislation eliminates accountability by taking their insurance product out of our scope of authority. It's not in our consumers' best interest to accept this, and as a state insurance regulator, I will do everything in my power to ensure that as currently written, it is not enacted into law into Washington. And I appreciate your time.
Thank you. Your comments are timely. We do have this as an agenda item for our PNC committee meeting tomorrow. So thank you for bringing that forward. I'm going to open it up to legislators for questions, but I do have one question. You were making mention about FIO and your conversations about the potential elimination. So would the elimination of FIO cement McCarran-Ferguson for state-based policy?
Well, Madam President, I think it certainly helps with that, right? I mean, I think it removes some of the duplicative touch points on what happens, especially internationally. When we go out and deal internationally with the IAS or with the other international forums, as it stands right now, a lot of our international colleagues defer to FIO because they're the federal regulator, not understanding that under our state-based system, they don't really regulate much of anything. And so I think removing that distinction and removing that potential confusion really goes a long way, not only I think domestically a little bit, but also certainly on the international stage. So I think it's a good step. And it doesn't mean, U.S. Treasury will always have the responsibility and the authority to look at the insurance marketplace. And so I don't think they're the a key financial regulator across our country. They're always going to have an angle or have an ability to understand and look at the insurance marketplace. I think where it sees for us is it removes some of the duplicative and perhaps confusing lines of authority. And again, when you get into the discussions around what they've been utilizing their power or authority for, I think I've been left a little less than impressed on how that partnership has evolved. And so political realities be what they may. I mean, I'm not sure if Dodd-Frank will be opened up to look at eliminating FIO. There's a number of other laundry list items that we'd probably like to have a discussion about if they do decide to open up Dodd-Frank. But I think it's also an important signal to send to the new administration that, okay, this is kind of where we're at, and if we want to have a conversation about what does an appropriateness of FIO look like, it opens the door to have that conversation as well.
Okay. And you were making mention about mitigation issues. I think some of the conversations you were on the fire task force, some of the conversations, and we've had wildfires in New York. You wouldn't think that that would be something happening, but it absolutely has. Relative to mitigation, who's responsible ultimately for mitigation? Because I know some of the conversation with some of the carriers that were coming out of California were turned off by the fact that California wasn't doing what they needed to do to mitigate some of the risks to stay away from having some of the wildfires.
Yeah, I mean, I think ultimately who's responsible is the communities, right? I mean, I think to me, and I'll happily defer to my other colleagues. We've had wildfires in North Dakota. Thankfully, we've got a lot of wide open spaces, so it doesn't necessarily impact buildings or structures. But when you look at, especially on the wildfire mitigation, it can't be a property-to-property piece, right? I mean, I can mitigate my home in wildfire, but my neighbor doesn't. It doesn't really matter. And so it's got to be a community-wide effort. It's got to be a community-led effort. And I think where some states are running into those issues, especially when you get around that building code or land use regulations, you want to talk about a political third rail. Those type of discussions are that political third rail. And so that's one of the issues too that cuts bipartisanly. I mean, I think everybody gets mad at everybody if you start talking about land use, you start talking about local regulations. And what we're trying to do, and I think what the House Financial Services Committee has at least signaled a little bit, is that this is more than the insurance industry's discussion. This is the builders, this is the communities, this is local government. I mean, it's really going to take all of us to become a resilient country on how do we address the risks. I think of North Dakota as a prime example. We know how to build against wind and hail, but we don't do it because the building code, it's not, there isn't an incentive there for our builders to build to that level of protection. We're often very focused on that first dollar cost of a home versus the lifetime cost of a home. And so I think you're seeing that conversation evolve and shift. It's like I said, it's not going to happen overnight, but I'm encouraged by that roundtable discussion was not about how terrible the insurance industry is. It was more about, okay, the federal government's going to pay for the post-disaster or pre-disaster. What do we want to look at investing into it? And that to me is actually a helpful conversation.
Okay. Do any legislators have any questions relative to the spring meeting or the 2025 priorities? Oh, yes, Commissioner.
Madam President, just to add to the mitigation question, just as an FYI, so we've got a number of states, certainly led by Alabama, with their Strengthen Alabama Homes Act that's the state of Oklahoma 100% copied, and we have just launched that March 3rd, and but we've got Louisiana, we've got Florida, we've got South Carolina that have similar programs, and I happen to know with the CIPR, with NEIC, there are almost 40 states engaged in conversations about moving forward with a similar mitigation program, most of them centered around roofs. Lots happening there.
Okay, let's move on. Next up is an update on the NAIC's framework for regulation of insurer investments, including its request for proposal for credit rating provider due diligence. We've had very productive discussions with the NAIC regarding its framework, specifically the part of the framework that dealt with the SBO's ratings discretion process. Ultimately, we feel the ratings discretion proposal ended up in a good place, and we appreciate you working with us on that. Now we're interested in this request for proposal for credit rating provider due diligence. The NAIC stated goal here is the establishment of a robust and effective governance structure for the due diligence of credit rating providers. So can you provide us with an update on your work on this and also some background as to why NAIC believes this due diligence is necessary, and also how the proposal interacts with the Federal Credit Rating Agency Reform Act?
Yes, Madam President, I'll cover that. So Nathan Hodak, Commissioner from Wisconsin, Chair of the Financial Conditioning Committee. So back in 2023, we released the framework for insurer investments, or what we call the investment framework. And a key part of that was enacting more oversight over ratings provided by credit rating providers. And so the last couple of years, we've been kind of moving forward on two separate initiatives relating to that oversight. The first one we adopted last year, which you mentioned, was the discretion over the ratings from SVO discretion under certain circumstances, and following obviously the parameters that have been established. That will go into effect probably January of next year. It takes a little bit of time to update the computer systems and other things that need to happen. And through that process, I mean, that played out over a year. There were 3 different exposure periods where we received a lot of stakeholder, interested party feedback and input, and ultimately ended up making a number of changes to address the feedback that we had received, including, as you mentioned, comments from NCOIL, where we made sure that there were regulators who had the ultimate decision-making authority at the end of that process. So now we are moving on to kind of the next phase of that CRP oversight, which is to develop a due diligence framework, basically establishing qualitative and quantitative factors that the CRPs would have to meet in order to be able to participate as credit rating providers that can provide ratings which then track to NAIC designations. We are, I don't want to say at the very beginning of this phase, it's been going on for a little bit, but we are in the process of hiring a consultant. We had issued an RFP last year after exposing that RFP, receiving comment, revising it based on the comments, and we've now gotten to the point of, I think we're in the process of finalizing an agreement with the consultant who will then work with us to develop that due diligence framework. And the goal is really, we like to use the term moving from blind reliance to informed reliance on the ratings that are provided by the CRPs. And there's just been a kind of a recognition among regulators that because of the complexity of investments and the shift in terms of the types of investments that we've been seeing, and also a shift in more private ratings that are being provided, there was a feeling that we needed to have more oversight in terms of those ratings, and have again informed reliance in terms of how those ratings track to NAIC designations and our accounting standards. And so that's really the kind of motivation and driving force behind this work. And as we move forward with engaging with this consultant and developing the due diligence framework, same as we did with the discretion proposal last year, there will be multiple opportunities for comment. We will expose our work along the way and really encourage NCOIL and all other interested parties to stay involved in the process and provide any feedback, input, ask questions throughout the process.
Is there an example that you could give that relates to maybe I don't want to say lesser, but maybe a smaller agency rating that had some sort of shift, maybe monetarily, that had you had these parameters in place that would have made something different, that it would have caused a change?
It's hard to call out specific examples. I think part of again, kind of the motivation and why this is being done is the shift that we're kind of seeing in the market. It's the shift in the types of investments where we're seeing more private investments, more private credit, that type of thing, just private capital in general. And related to that, there's the ratings are more private. So typically when we had corporate treasuries or other securities that were public and then the ratings were public, you had kind of a market validation process. You had multiple ratings that were seen by everyone in a public forum. And as the assets have moved into more of the private side and then the ratings have become more private, you don't have that same type of market transparency and validation. So developing this type of framework and putting in place these qualitative and quantitative factors is really critical for ensuring kind of the quality and validating the quality of the ratings. So I can't really speak to a specific example, partly because that's often confidential and proprietary information, but it's really, a lot of it is driven by the shift that we're seeing in terms of more private investments and more private ratings.
Okay. How long do you think this is going to take?
Oh, hopefully as quickly as possible, but with enough time to make sure everyone has opportunity for input. And we're just getting the consultant hopefully on board in the next month or two. Then it'll take some time to start engaging with stakeholders. So, it won't be finalized by the end of this year, but we're hoping by the end of the year to be making pretty good progress going into next year.
Thank you. 2 questions. Tom?
Thank you, Madam President. I just, again, wanted to thank you all, particularly Commissioner Hudick. I wanted to thank you for inviting us to tour the SVO last year, and I felt like that was very informative. I hope that we continue to have opportunities to learn from each other, and I thought that was very good in terms of helping us to understand the importance of what you're talking about with creditworthiness. It really is a lot that goes into it. And I think I can speak for the other members that went that we sort of kind of understood that, but having gotten a chance to put our arms around it and realize just how big of an operation that actually is, we appreciate it. So thanks.
Thank you. Appreciate that. And if I could, just one last point, and we've made this point before last year, and we will continue to as we're working through this due diligence framework processes. The intention is to continue to rely on ratings that are provided by credit rating providers. That's a critical, the filing exempt process is critical, the involvement of CRPs. That process has worked well, it continues to work well. We are just adding some layer of oversight from a regulatory standpoint, but we still very much want the CRPs to be involved in this work.
Any other questions from legislators? Okay, I think everyone's got the after lunchtime blues here. So we're going to go to one of my favorite topics, AI. And my first question, actually, it's just kind of a joke, but will you be using an AI-generated framework for your due diligence model? Just kidding. Okay, so as we're all well aware on both the legislative and regulatory levels, AI does continue to impact the insurance industry. And in response to that, seemingly every state feels a sense of urgency to enact laws on AI that strike a balance between making sure that consumers are protected and not hindering innovation. And tomorrow afternoon, we will be having a general session on this topic titled AI in Insurance: What is the impact of losing the human element? The goal of our session is to gather some information as to how each line of insurance is utilizing AI and how each line views AI's benefits as well as problems. Afterwards, it's likely that our multi-lines issues committee will start discussing some potential model legislation to develop based on some laws that have been passed or introduced in several states. And I know from my perspective, I'm extremely interested in this because I do have a few bills in New York relative to AI. One requires insurers to notify insureds about the use or lack of use of AI-based algorithms in the utilization review process, and requires the insurance department to certify that these AI-based algorithms have minimized the risk of bias based on certain things like the covered person's race, religious creed, age, or gender. So before we get into the NAIC's work on AI, I wanted to see if any of you would like to comment on what you have been seeing in your states in terms of AI-related legislation or regulation.
Thank you, Madam President. Happy to just discuss generally what we're seeing from a landscape first before we get into some meatier comments. But generally speaking, there continues to be extreme interest in what AI is doing within a lot of landscapes, including the insurance space. There's a lot of activity that is traditionally human-oriented with human knowledge and skill sets that is moving into an artificial intelligence framework or another type of tool that can appear like artificial intelligence. And so what we're seeing in states, I know particularly in Florida recently, this past session, there are bills up this year that ensures that there's human activity, a human component that remains in any, after any initial screening, for example, in a claim denial that might take place, but there's still, if an artificial intelligence process denies a claim, that there is still ultimately a human overseer that is, overseer is an interesting word in this space, but that there is some human element involved in that process that ultimately is making the decision. And I think we're seeing laws like that attempt to generally ensure that there is that human piece of the puzzle that remains throughout the process, so that's for the benefit of ultimately the consumer.
You do have a model, or I guess a model bulletin on the use of artificial intelligence. Can you share with us, I guess, an update, how many states have adopted the bulletin? And I guess then also touch on what the NAIC's next steps are related to AI in terms of other model bulletins or regulations or laws?
Absolutely, thank you, Madam President. The overall work of the NEIC, just to broaden that out a little bit, it sits on each committee and is in really primarily two working groups. The first one is Big Data and Artificial Intelligence directly. The second major working group within that committee is the third-party modeling working group. And that probably has, each one has some overlap on the other, but when we get to exactly, to your point, particularly when we talk about the model bulletin that was issued, 24 states have adopted that model bulletin so far. We think there'll probably be more that do so along the way. The NAIC at this time has opted to move in the bulletin direction for this kind of, as we kind of look at the big picture about how things are going. One thing that we're very conscious of is not over-prescribing a model law immediately that would suppress innovation and ultimately a better outcome for consumers, potentially, and a better outcome in the cost of insurance for consumers. It's not to bleed too much into affordability and availability. We do generally, I think most of my colleagues would agree that AI has great potential to reduce costs in claims handling and other things, but it's ensuring at the same time that human element remains present. There's ownership over the technology that's being employed. So we'll continue to see. I think the principles was kind of the next step for the NAIC and how it's going to look into this space. And then separately, we have the third party modeling group. We'll see what develops with that over time. That is a huge other component that's related to AI, and it's the modeling that goes into so many different outcomes and determinations that really break into the work of insurance and predicting what the future looks like to the best of our ability. And so as we do that, we're going to try and do this thoughtfully, carefully, smartly, but appropriately. We're going to take the steps we need over time to put things forward that we think benefit and protect the consumer ultimately.
Commissioner King?
Yes, Madam President. One of the things that we're also seeing is we're seeing a tremendous amount of filings. And so the length of the filings are getting more and more complex. And I see a world relatively soon where regulators will have to start using machine learning tools to go through these filings to determine what is the difference between this filing and the previous filing, because we can't staff at the rate. We couldn't staff human beings at the rate our budgets of any of our states would not allow us to. And so we're going to have to start looking at some of the use of these tools to screen out things that we're sensitive, discrimination, redlining, those things that, and so we're looking really hard about how to appropriately use those tools as regulators.
I was just kind of anecdotally, I was actually a computer science major, and I mention this frequently. The first class that you take is, they say, GIGO, garbage in, garbage out, right, when you're writing code. And my concern always has been with AI, it's great when you're watching the videos on, line and it looks fun and whatnot, but and I use this in an example like in a health scenario, and that's why we were really looking at having eyes on a claim, if there's a denial, eyes on it. Because your provider knows you better than a computer algorithm will. And so the garbage in, or the information in, will dictate what comes out relative to, you broke your neck, you need 6 PT sessions, the algorithm says 6, but your doctor knows you're not a very compliant patient, and you're really gonna need 12. And so these are the kind of intricacies that and for the great things that technology has done, I guess following up to one of the things the prior commissioner mentioned is technology innovation. We want to be right there, and we are talking about making sure there's consumer protections, and there's not enough people, you know, obviously there's not enough people to do the work, but by the time we enact something, the technology is already ahead of us. So where are we, how are we trying to combat this and still use technology to our advantage?
I think that's a great point, Madam President, and I think that's part of the NAIC's approaches in this is to make sure that we're moving in a direction that doesn't overcompensate to the point that whatever it is whatever model law, for example, we passed isn't irrelevant by the time it gets there. You know, one thing that in your comments that strikes me is Florida is a state that has a modeling commission around hurricane catastrophe models, and it actually, that commission is a number of agencies are part of that, and private, as well as some private contractors that actually unpack hurricane catastrophe models to understand what it is they're doing, and then either certifies them as, not to your point about garbage in, garbage out, it doesn't necessarily certify that the validity of the data or the usage of it, but it at least validates what it is saying it is doing all throughout that process with that data is actually what it's doing and providing a genuine outcome from that front. And so I think that it's such a complicated discussion. When you add an AI layer on that, say a model that is then using generative AI and making its own determinations about what is weighting data in a certain way to its own sentiment about what is the most appropriate data to utilize. That would be an additional layer that it is going to be a regulatory challenge in the coming decades, I think, no matter how you slice it. And so when we look at what we want to do in this space is be fully informed about what is taking place in the AI realm, and then also about what the hazards are around that for the consumer and or the market or the industry, frankly. And that's going to take a significant devotion of resources, I think, at the state level, the NAIC level, NCOIL level, all these entities, perhaps some tertiary involvement at the federal level, but the bottom line is it needs to be monitored, we need to be aware, we need to know at a minimum that the things that these AI tools or models are doing are what they are saying they're doing, and that is appropriate and consistent with existing laws.
If I may just add one more on that. I think one thing that we found too as we've gone through this process, 8 years ago, I inadvertently raised my hand to be the vice chair of Innovation Technology Task Force, not knowing that the chair was going to resign 6 months later. So all of a sudden, I'm the new commissioner, and I'm the chair of the Innovation Technology Task Force. So we're going through this. So I've been involved in this discussion really since the beginning. And I think we're seeing the conversation evolve to all those points that we've discussed. But I think it has also continued to evolve, and I don't want to lose sight of that third-party vendor access portion. I mean, we can pass insurance regulatory schemes. We can pass all these things that say, thou shalt not or thou shalt do. And if they're entering into a vendor contract with a vendor to provide some of these services, we haven't really been able to find a good way to pierce that veil yet to be able to get into that vendor who is not in our authority, right? We don't have authority over those kind of technology providers, and we're seeing a significant amount of growth in that space. And it's putting our industry in a challenge, it's putting us as regulator in a challenge, because we don't know quite how to get through to that third party piece yet. And so we have an entire working group that is tasked with trying to come up with that. And again, I think we've kind of honed in on the point that, you know, the buck stops with the insurer. So you're responsible for your vendor's access and all those things. But when it gets into wanting to see the contracts and what kind of things they've entered into for services with that third-party vendor, we've been pretty shielded from confidentiality and proprietary and all those pieces. And so it would be a little bit, I'd say somewhat naive of us to think that, you know, because we pass certain insurance-specific regulations on artificial intelligence, that it's going to somehow affect that broader service market. And I think you're seeing that all over the place. We just passed a law in North Dakota. Our prior authorization model has an AI piece in it, that you cannot have prior authorizations done solely by artificial intelligence, to your point exactly. And so I think we're seeing it cross lines now too. It was traditionally kind of in the P&C space, a little bit in the life space, and the health side, and like, that's really complex for us, but it's coming, and now we're seeing it come there too. And so this will continue to grow, continue to evolve, and like I said, I think we've been we've been working on this for the past 8 years. You see or at least since I've been there, you see the evolution over time, and that third-party piece is going to be a big question that we all have to answer, and how do we handle a third-party vendor in this industry?
Representative Oliverson?
Thank you, Madam Chair. I think one of the questions that always I ponder on with this is so much of these decisions that we talk about with regards to what AI may or may not be able to do, we sort of just say, well, we're going to hold the insurance company accountable. But the reality is, when we talk about third parties, so much of decision making is actually done by licensed professionals. And those are individuals who have demonstrated competency in an area, received training, but they also have a certain self-preservation aspect. If I'm an engineer and I review the plans for a condominium complex that ultimately collapses and takes a bunch of lives, I have both civil liability, but my professional license is also on the line. And I just wonder, as we're contemplating all these things, somebody had mentioned utilization review earlier, if you're making a decision about medical necessity in an insurance claim, that's the practice of medicine, 100% every time, can't be avoided. So does the machine have self-preservation instincts when it comes to the importance of preserving its own licensure? And could you even license a machine? And if not, do we even have a system that exists from a regulatory framework to ensure that there actually are checks and balances with regards to good decision making, whether you're an accountant or whether you're an engineer or a dentist or you're cutting people's hair? I mean, as human beings, that comes into play, right? And I'm not sure that it does with machine learning. So I'm just curious, have y'all contemplated the regulatory aspects of how licensees and licenses for individuals that may be consulted play into what AI can and can't do safely?
Those are great thoughts and great points, and I think the answer is yes. And when we talk about, for example, ownership of that, you would be in a situation. Let's just take simply in the insurance space. Let's take an actuary that is utilizing some sort of AI technology to help that actuary make a determination about something. In that case, the important feedback ultimately that we would probably want to find ourselves ending up at from a regulatory space is that that's great that the actuary used an AI tool to help them, but at the end of the day, it's more complicated. But at the end of the day, they could have utilized an abacus to find their determination. Either way, the determination is still on the learned professional in that case, and that would be the actuary. And then that's when we talk about the development of this, both within companies or as regulators or as others, one of the key terms that keeps on coming up is ownership of the tool, of the AI device.
And I get that, but we're talking mechanistically about AI. And what I'm saying to you is that so much of what happens is based on someone's, quote, professional opinion. That doesn't strike me as being something that you can license a machine to do, because there's no accountability.
I think you're correct. So at the end of the day, it would not be, and I think that's why when we talk about that ownership, it is just because the learned professional, the licensee, utilized AI as part of their mechanic, they are still owning and responsible for the ultimate outcome that's determining. It's that human factor. We can't place an AI in prison, at least not yet, or fine them a fee, but you can the individual that employed that tool or utilization. And I think that's the framework that we would look at this under.
So your insurer would still need to have actuaries as human beings that are licensed professionals within that space in order for that to work. That's kind of what I'm getting at.
The way we communicated this is you can use the tools, but ultimately the company, the individual is who we're going to hold their feet to the fire. That's who we're going to go sanction, and that's who we're going to go after their license if they misuse these mechanical tools. And the way I see this is the mechanical tools are there to take care of routine, repetitive tasks. But there still has to be a human being that is accountable whether they use a calculator, Texas Instruments, whatever, you know, from our generation, that's just a tool. That does not, is the individual, the company, the person that we've licensed is who we're gonna hold accountable.
And if I may, I would just add to that, similarly with what John mentioned earlier about third-party models and third-party modeling. It's a similar concept if you just take the AI term out of that and you replace it with a third-party model of some kind. Ultimately, you know, in our view, if we receive a rate filing that has data or some sort of calculation that came from a third-party model, at least in Florida and a number of other states, it's not the third-party modeler that's accountable for that, it's the insurer. But it's that discussion kind of in a different way that you're talking about, which is, well, who's watching the modeler that is building that model to make sure that that model is providing the product that the insurer thinks it's getting at that point, and then providing to us for review or for use. And that's where this gets to. That's the complexity about all this, is making sure that we're moving in a direction where we are encouraging its use, but also that there are appropriate internal company safeguards, but also regulatory safeguards in place along the way.
Thank you. We do have a couple of more topics here we wanted to go over before our time is up. I guess the next thing I wanted to bring up was relative to affordability and availability, and I think that's the forefront of every person's mind and something that comes to us via our constituents, and I'm sure you know, with you and your conversations relative to conversations with the insurers, things haven't gotten better, right? And the headlines about insurance rates and insurers leaving markets started appearing in national news outlets, and you know, obviously we're all a little shocked. I know I got a little gut punch during my increased premium from my property casualty plan. But I think we'd all be hard pressed to say things have improved a lot. And in some instances, things have probably gotten worse, particularly out in California. We were mentioning due to the wildfires, I guess, earlier this year. Tomorrow, during our PNC committee, we'll be hearing from Commissioner Yawarski about some steps Florida's taking to improve the property insurance markets there. But before that, I think it's a great opportunity for us all together here to share some experiences you've been seeing in your states and some work that you've been doing on these issues, both from an individual state and NAIC capacity. So can anyone speak to that?
I'm happy just to kick it off, not in a Florida specific way, but in a broader sense, and then move on to my colleagues. But the issue, I think we all face it probably from the same direction, which is our own personal concern about the viability of insurance within property insurance, especially within our state bounds, and for our consumers that exist within our states. And it has been a pressing issue. I think Florida probably experienced the impact first, but it is spreading to other areas of the country as well in a concerning fashion. The NAIC has taken this year under President Godfrey's leadership and C Committee Chair's leadership, one initiative particularly that revolves around an affordability playbook that is designed to ultimately be a product that can be given at the consumer level to help them understand what is driving insurance costs, what can be done about it, what can you do within your own arena to provide a matrix to help explain the situation around insurance. More broadly speaking, what I would say is at the end of the day, when it comes to insurance, the capital must come from somewhere to cover a loss. And what we are experiencing in the property space as well as the auto space with particularity is, more broadly than just a single state, is the inflation-driven performance that we've seen over the past several years has been remarkable. Just to give a Florida example, because that's what I'm familiar with, but the total insured value of Florida's property insurance market, which is how much it would cost to replace the totality of that marketplace, has nearly doubled in 4 years. And with that comes along the labor and goods and everything to put someone in that home. When you're buying more bricks of insurance at a certain rate, your premium is going to go up. And that's what a number of consumers are experiencing, just beyond any kind of individual state-by-state basis. That is a crucial component of the overall experience consumers are having. And you combine that with state-by-state experiences that may be existing, it has been a challenging marketplace for companies to operate in. It's been a challenging environment for consumers to purchase insurance, which is, none of that is ideal. But I think longer term, when we spoke about mitigation and resiliency earlier, it is truly the thing that I think we need to be focusing on as regulators, probably the most. But it's also the thing that is not the easy win. It is, I've been, since I've started talking about this in Florida and elsewhere, I'm always reminded of a quote that societies grow great when people plant trees, which they will never sit in the shade of. And that is really the story of, I think, mitigation and resiliency. Just looking at Florida's history, we see in a scenario where we're just now seeing some of the benefits of hardening our building code in 2003. And making it, we're just now seeing that building inventory to be significant enough with that where the state can move in a direction of potentially actually having a viable insurance market. It's kind of hard to imagine what Florida's market would be like without that. But I think broadly, this is top of mind for all of us, is the affordability, availability, and also I would say the reliability. You know, the only thing worse, I think, than a consumer's insurance rates going up is a consumer's insurance rates going up, and then that company not fulfilling that obligation to make someone whole again on the worst day of their life. And so there's multiple elements to this. It's extraordinarily complicated, but I'll open it up to John or others if you want to.
Yeah, I think Mike covered it very well, but I think one thing that we're running into is I'm not sure we're in part of the availability and affordability playbook is I'm not sure what levers we can pull at the state level that have that immediate impact that I think consumers, policymakers, or communities are looking for. Given I think the structure of our market, and so I think you're seeing more and more discussion around the cost of insurance, maybe even be starting to impact the ability to purchase a home, right? And so maybe a barrier to that home buying. And again, it's to Mike's point is you've got to look at the underlying cause of some of that, and that is, North Dakota alone, our materials are up 30%, our labor is up 20%. That's going to be reflected back in rate. It has to be. It just has to be, and there's nowhere else for that to go. And that's a really hard conversation to have, not only with the consumer who's, and again, in North Dakota, it's really hard for me to say, well, at least it isn't 40%. I mean, a 20% rate increase is a 20% rate increase. I don't care what's going on in other states, and it's still impacting me. And that's on top of other inflationary pressures they've been feeling at the grocery store, wherever. And it's like, and now all of a sudden it's like, and now another 20% on my home, and how am I going to continue to afford to do this? And so, we're trying to have that conversation. It's really hard in a state like North Dakota to have that conversation around mitigation because we haven't had that catastrophe. And I think that's an opportunity for us to come together and have that conversation before the disaster happens, is how do we have that broader discussion of, okay, if we start taking the steps now in the Midwest, or we start taking the steps now wherever, in whatever your state is, again, you're planting that tree that you'll never enjoy the shade of. And we're eventually going to get there. We're eventually going to have to get to the point where we've got hardened homes or fortified homes or whatever tool you want to use to have that resilience to be able to have and maintain a viable insurance market. It's a matter of when do we want to start that discussion, and that's a challenge.
I think some of the conversation needs to include, and I see this happening in New York, but I'm sure this is across the country, and you made mention about neighborhoods being responsible for mitigation, and I think that's very important, and building codes need to be changed. There are a lot of people, a lot of influence and interest out there that want things to remain the way that they are, and one of the things that we find, especially as we're passing state laws for the lawmakers here, is one of the things that municipalities keep close to the vest is home rule. They want to be able to do what they want to do in their neighborhood to keep it however it is, whether it's NIMBYism, whether they like the neighborhood the way that it looks. But we can't force them to do something. And I think it's getting to the point where I can't force you to be a good neighbor and really take into consideration mitigation, because they're worried about school budgets, they're worried about picking up trash and police and fire, but really at the local level, there needs to be some sort of responsibility, accountability, conversation relative to, that's where it starts.
Yeah, and I think you see how this plays out long term, and I'm not here to pick on any particular state, but you play this out in California, and then your insurers leave, right? If there is an incentive, if there isn't a risk mechanism if a community hasn't taken the appropriate steps to protect that risk or to mitigate that risk of that community, there is little to no incentive for an insurer to invest in that community, right? And so that's how that plays out long term, and that's a challenging conversation to have because it's until it's a problem, it's not a problem, right? Until it's immediate, and then it's, you know, John, why are you letting this insurer leave? Well, I don't have a law in my books that says thou shalt write certain risk. Nobody has that law, and nobody should have that law. But it's understanding that that's a risk transfer, that there's an investment there being made by the insurance industry, by the community, and by the consumer that all has to play together. And if one of those three legs of that stool falls over, there really isn't. It's a challenge to have a market there.
Madam President, in Georgia, we pursue all these, you know, these great levers, but what we've done is we share half of the insurance premium tax with every city and county in the state of Georgia. And I've gone around the state and advocating for our legislature to start putting some strings on that money and how that money is distributed back to local communities. And so we know how that mechanism works. You know, communities will do things that when they know that there's something at stake. You know, I used to be a local police chief, and I used to hear all the folks talking about affordable housing, but not in my neighborhood. And it's like, so we get it. But I think once you start putting that carrot and the stick, that's how we're going to get that movement. And that's where the legislature has got plenty of levers, because I think that's the only way that we're going to get moving in the direction. And my advocacy is that the premium insurance taxes of insured local communities ought to be used to reduce overall risk. And because we know that if we reduce that overall risk, the benefit to the communities is they're going to have lower insurance rates for the properties. So I would suggest those are one of the things that I would recommend taking a look at.
Thank you. I wanted to go into, I guess, our last agenda topic is relative to long-term care insurance and a multi-state review approach that I guess NAIC is currently working on. Biggest cost for Medicaid, obviously in New York and probably across the country. And so just wanted to hear what you all are working on relative to long-term care in your working group.
Thank you, Madam President. I'll cover that, and I'll try to cover it quickly. I know we're short on time. But before I do that, if I could, I just want to acknowledge the progress we've made with our two organizations. There's a number of people at this table who have, and I know I sound like a broken record. I say that every time, and probably young people here asking what's a broken record, but we have made great progress. We have 8 commissioners here. We have 2 of our national officers here, so I just want to acknowledge that. So long-term care, it's been a big issue. We're trying to get, everyone's trying to get a grip on that important coverage, rising premiums. So in 2022, established this long-term care insurance multi-state actuarial review framework. Think about that acronym. But we do stick with MSA, just as multi-state actuarial. So basically the thought is they file with that group because many of us don't have those individual resources within our departments. Then they develop some recommended rate increases. The states are then allowed to use those or not. It's not a mandatory thing, but there's a centralized resource of multi-state actuarial process. Most of those funds go directly to the department. In 2024, the actuarial working group, long-term care working group, was charged with developing a single long-term care multi-state review process. At the time, there were 2. We had Minnesota and Texas sitting right in front of me, and there were 2 different approaches. But then that seemed a little bit confusing for folks, and so then there was the attempt to move to one, to have a more transparent and explainable single methodology. And I'll take off the drama, and in that bracket, Minnesota won. So sorry, Tom. So that was in October of 2024 that single approach with the Minnesota approach, if you can call it that, has been adopted. The working group now has some open comments on some proposed sets of modifications. There's 2 sets in there. The comment period is open until May 12th. Throughout this year, that will then go through that process, through the working group, through the task force, and then onto the B committee, which I chair at the NIC this year, and then ultimately to our executive committee and plenary, and hopefully be approved for there. So that will be that step process. So.
I do think that either summer or fall we'll be having a panel on developments in long-term care insurance. So I would definitely like for NAIC to be part of that conversation, your perspective, and the work that you've been doing in the framework. This is a huge cost to all of us in all of our states, and definitely need to get a handle on this the best way we can, for sure. Thank you. Is there any other business before this committee? Yes, sir.
Thank you, Madam Chair. Brad Nail, representing Airbnb. Airbnb was directly referenced earlier in the comments around the rental home marketplace model. Just would like to point out that we look forward to addressing these issues that were raised during the committee tomorrow, and that the model itself is, in fact, the product of extensive discussions with insurance trade groups and is really tailored also to meet the concerns of the insurance industry. But we look forward to speaking about this further tomorrow.
Okay, thank you. Any other business? If not, before we adjourn, I'd just like to note we get 5 minutes, 5-minute break. We will meet back here before our general session on prescription drug affordability boards. We're tight on time, 5 minutes. Can I have a motion to adjourn? Second, all in favor? We are adjourned.